Okay, it's 8 a.m. and we should start. Hello, everyone. I really appreciate you being here. I know it's 8 a.m. on the first day of the conference, so we really appreciate you taking time and showing up. My name is Isil Erel. I am a professor of finance, David A. Riss-Miller Chair in Finance at the Fisher College of Business of the Ohio State University. And it's my great honor to chair this panel of excellent researchers. Today we are talking about private assets with a focus on regulation and I think more on fintech. So we will be covering a variety of areas within this topic, from private equity and private debt to real estate finance, advising, especially robo-advising. This is a very big and timely topic, and today they are recording our lecture, and we will be looking forward to your engagement as well. So the plan is as follows. We will all take about 8 to 10 minutes to talk about our respective research within this topic. And then I will ask some questions to the panel and start some discussion. And then we will spend the last 45, 50 minutes of this panel answering your questions. So please, when we talk about our respective research, please think about questions, and I would really love it if you get engaged with us later during the discussion. So with that, I will start talking about my research a little bit before I introduce our panelists. And my focus here will be on private debt. I will be talking about private debt to small and medium-sized enterprises, SMEs. When we think about private debt, we used to think about banks because banks were the typical lenders to these small and medium-sized enterprises. But over time, things started changing. We started seeing more of non-bank involvement. First, in the syndicated loan market, especially in the leverage loans, we started seeing non-banks, non-commercial banks dominating this market, especially, again, in term loans, highly leveraged term loans. And after the financial crisis, things started changing a lot more. We started seeing these non-banks directly lending to these firms, finding borrowers and directly lending to these firms and keeping these loans on their balance sheets rather than securitizing them. So they started acting like a bank. I have a paper with Robert Plinemeyer and Sergei Chernenko, where we look at this growth in non-bank lending. And we show that after the financial crisis, about 1/3 of middle-sized firms started borrowing from these non-banks rather than the banks. And these were mostly cash flow-based loans, and I will come back to this point later, to mostly riskier borrowers than a typical bank borrower. They often had, for example, negative EBITDA, negative profitability. Most importantly, in the paper, we link this growth to the bank regulation. That's one of the topics of focus today. We find that increased bank regulation was the main reason for this shift towards non-bank lending for these types of borrowers. But then, going forward, in the past 5-10 years, when we talk about non-bank lending, now we are talking about private debt funds. These are funds that focus on private credit in terms of their portfolio of investments. And they are typically sponsored by private equity firms or business development companies. These credit funds raise money from their investors, the LPs or investors, and provide, again, mostly direct loans to small and mid-sized firms, and they keep these loans on their balance sheets. Now, I'm talking about an asset class with the largest growth in the last 5-10 years. You cannot imagine how many calls I get about this. I think every week I get a call about this from researchers, regulators, practitioners. Largest money managers like Apollo, Ares, Blue Owl, BlackRock, all own private debt funds, or BDCs now, and multiple of them. Private debt as an asset class even surpassed like $2 trillion around the world, and US dominates this market. Of course, it is getting very popular in Europe and UK as well. And when we talk about private debt, there are a variety of structures within private debt, but mostly the focus in the later time period has been on direct lending, and which is about 60% of this total amount. Unlike commercial banks, these funds lend to, as I said, riskier firms with higher leverage, and their focus has shifted lately. For example, lately 60% of their lending is to leverage buyout firms, but they also lend to smaller firms. It's important to note that these loans are not, again, securitized and kept on the balance sheets of these institutions, and that's important to emphasize because the structure is very different from the CLOs of the financial crisis. Again, these are loans that are initiated and negotiated by these lenders, so they are acting more like a bank rather than an arm's length lender. So given the types and riskiness of their investments, it makes sense to compare this market to the leveraged loans market, broadly syndicated leveraged loans market, or the junk high-yield bond market. So I should emphasize that in terms of size, private debt surpassed both these markets of broadly syndicated loans and high-yield bonds. In fact, one fun fact is that they even started engaging in mega deals of $1 billion to $5 billion, taking over deals that would have previously gone to the high-yield bond or syndicated loan markets. Okay, in the last few minutes of my time, I would like to talk about returns to the investors of these funds. Given this growth, given that this is the asset class with the largest growth in the past decade, I think it's important to understand whether they generate any alpha for their investors. So what about the returns to the investors, to a typical investor into a private debt fund? Practitioners tout the high returns. They always say high returns with almost no risk or prospect of loss. They compare them very often with senior bank loans. But in our recent work with, in my recent work with Thomas Flanagan and Mike Weisbach, we find that an average investor in these funds earn only a rate of return that covers the risk she takes and the fees that she pays. Let me elaborate more on this because it will be very important when we discuss other aspects of this market later on, especially think about democratizing investment for a retail investor. So I will share two important findings from this research. First of all, these funds are called private debt funds, but about 20% of their investment is in equity-like instruments. And this is not only warrants or preferred equity, they often invest in common equity as well. And actually, these hybrid structures are getting very popular. I have some other work where we show that even the same fund invests in the equity and the debt of the same firm. And it's very interesting to think about that as well. Plus, as I explained earlier, a typical investment on the loan side is riskier in these funds. Then properly adjusting for risk would be rather important. We have a very nice, unique data set from Burgess covering net of fee cash flows to the investors of these funds. And considering the timing of the cash flows and the horizons of the investments, what we do is that we reflect these net of fee cash flows on public benchmarks and for which we know the prices. And in this way, we can calculate the NPV of $1 of investment in this type of fund. And what we find is that when we only consider the bond factors, we find positive NPV. But when we incorporate both bond and equity factors, average net alpha for this investor, for this type of investor, is zero. Again, you know, there's a variety of funds. Some funds produce more alpha than others, and there might be other reasons for investors to consider this type of investment. But it's very important to understand that average net alpha is zero. So I would like to end here before I introduce my speakers with two important notes. First, as I also touched on, before, these funds now act more like a bank, negotiating with the borrower, including financial covenants, renegotiating on the deals, and also including hybrid structures in their deals. And perhaps most importantly, while the focus had been on cash flow loans, lately we started seeing asset-based loans as well. So private credit is moving beyond corporate loans to cash flow-based loans into these asset-based finance, including equipment finance and others. And some of the latest defaults that we saw, like Tricolor or First Brands, they were these types of investors or cases that we have seen. Okay. So I won't be continuing talking all the time. I'm here with an excellent panel. Now it's my honor, it's my pleasure to introduce our speakers. They are seated here using their last names in order. So I will start with Viral. Viral is the CV Start Professor of Economics in the Department of Finance at NYU Stern. He's also affiliated with NBR, CEPR, and ECGI. Viral was the Deputy Governor at the Reserve Bank of India during 2017-2019 time period, in charge of monetary policy, financial markets, financial stability, and research. Viral's primary research interest is in the theoretical and empirical analysis of systemic risk of financial sector, its regulation, its genesis in government and policy-induced distortions. So today, Viral will be talking, among others, about linkages between non-banks and banks, and I'm sure he will touch on the systemic risk concerns. Victoria is next to Viral, and Victoria Ivashina is the Lovett Learned Professor of Finance and Head of the Finance Unit at HBS. She's also affiliated with the NBR and CEPR, has been visiting scholar at the Federal Reserve Bank of Boston, a member of the Model Validation Council at the Board of Governors of the Federal Reserve System. Victoria co-heads HBS's Private Capital Initiative and Private Equity and Venture Capital Executive Education Program. Her research spans multiple areas of financial intermediation, including corporate credit markets and value creation by private equity. And today, Victoria will be focusing on private equity, among other topics. Okay, Tomasz Piskorski is the Edward S. Gordon Professor of Real Estate in the Finance Division of Columbia Business School. He's also the Research Associate at the NBR and serves on the Academic Research Council of the Housing Finance Policy Center at the Urban Institute. Tomasz's research explores issues in real estate finance, securities and mortgage markets, financial intermediation and banking, market structure and regulation, and housing policy. Today, he will be focusing on fintech and real estate and consumer loans. Last but not least, we have Alberto Rossi. He is the Hatchigan Family Professor of Finance at Georgetown. He's also the director of the AI Analytics and Future of Work Initiative at Georgetown, a visiting fellow at Brookings, and a member of the Economic Advisory Committee at FINRA. His research interests include household finance, fintech, and machine learning, extensively analyzing big data, including how robo-advising can help individuals make better financial decisions. And today's focus will be fintech, AI, and advising, especially robo-advising and savings. So I asked the panel to prepare, again, about 10 minutes each of introductions, with 3-4 main points from their research. And as you see, we will cover a variety of research topics. But we will combine our points on private assets and technology. I'm sure they will bring up at least one major issue in private assets that puzzles them. And I will come back and discuss that during the Q&A. Of course, we will do that with your questions as well. Now it's over to you, Viral, to start.
Thank you, Isil. Good morning, everyone, and thank you for being here. So I'll just wear my financial stability hat, as I tend to do, and focus on perhaps what might be some considerations worth thinking about with this new kid on the block, which is private credit. Just 2 words on some research I've done. It's mainly to give some attribution to my co-authors as well. It's joint work with Nicola Cetorelli of New York Fed and Bruce Tuckman, who's my colleague at NYU Stern in the finance department. We've done 2 or 3 pieces now. Isil has been kind enough to publish one, which was a keynote of sorts at the Macroprudential Risk Conference of the Riksbank, called Where Do Banks End and NBFIs Begin? And another one which is going to be presented at the panel tomorrow of Journal of Finance Insights and Perspectives, which is, it all looks like transformed intermediation with solvency risk to NBFIs and liquidity risk staying at banks. So let me segue from that into my first point, which is that it's not that non-banks are growing without the support of banks. Okay, so that's the first point I want to make. Every time you observe some non-banks growing, they are on the back of the banking system. And the reason is simple, which is banks remain the repositories of large pool of deposits, a large pool of real savings in the economy. The only intermediaries which seem to compete with them in attracting such large pool of savings are insurance companies, pension funds, and to an extent, money market funds. But all these credit intermediaries which are springing up on the side, they don't seem to raise a lot of real savings of the economy on their own, not in the large magnitudes that we see them. And we think the reason for banks remaining at the back of the non-NBFI growth or non-bank growth is simple. I think as Isil mentioned, every time you have a bank regulation put in place, you are trying to create some wedge between the private force and the social requirement, which is private forces are trying to create some extra risk, some lending down the quality curve, some undertaking of credit or liquidity risk or both. And prudential regulation is trying to create a wedge in that growth, like throw some sand in the wheels. So naturally, there is some force to move stuff out of the banking system, wherever this force bites the most. And of course, that is a very simplistic view of non-bank growth, which is that if you put restrictions on banks, non-banks grow. Okay, but then we have nothing to worry about. If we think that non-banks don't have access to the government puts, then this is a better way probably of organizing the system. banks are the ones subject to runs, non-banks won't be subject to runs, and you solve the problem by regulating the system better. But what you see when you observe things closely is that the reason why banks remain connected to the funding of the non-banks is because banks still have an inherent liquidity advantage because of this access to deposits. And it's not just access to deposits. When you think about the access to deposits, at one level, it's their stability, but the ultimate source of stability of deposits is actually the government put, the Federal Reserve backstop or central bank put that stands behind them. So in times of adversity, in times of high VIX, in which case non-bank finance seems to experience a repricing of a very high magnitude, of sorts that requires them to dash for cash, as we saw at COVID-19 outbreak. Invariably, the intermediation shifts towards banks in one way or the other, because banks experience a flight to quality of deposits, unless they are blowing up themselves, as in the 07-08 crisis, or the Federal Reserve unleashes a pool of liquidity sprinklers onto them. And therefore, the reorganization of risks that happens at that point is that the entire shadow banking system becomes dependent on the banking system for liquidity. So it's almost like as though you have to think about these balance sheets together, even though in good times they could be thought of like in isolation of each other. So my sense is that this point is pretty important. The fact that in good times, non-banks are growing because they are arbitraging some regulations around the banking system. They retain pipes to the banking system so that risks can seamlessly flow back to the banking system in a state contingent manner and in a manner when the non-bank finance will dry up or experience big costs of revision in their costs of capital. And that ultimately the liquidity risk is going to be put on the banking system and perhaps onto the government backstops. So viewed this way, to caricature, like every non-bank looks like a special purpose vehicle of the banking system, which warehouses the solvency risks until the liquidity risks materialize, which could be because of solvency risk, it could be because of market risks of other types. It used to be that the thinking was that behind every non-bank, there is a government-induced distortion in the form of bank regulation. But our contention is that behind every bank, behind every non-bank, there is actually a bank, or there is the banking system that's growing in contrast. So in our paper, we try to show what these linkages are and how they play out in times of crisis. Now, the second point is private credit could be different. Why? Because we don't yet have enough data on their liquidity risks. As Isil mentioned, they've grown mostly in the last 5 years. They weren't big at the time of COVID. They were kind of large, but not too large. And because they are private, we don't observe too much on their credit lines and their drawdowns from banks on an ongoing basis in administrative data. Or at least not in public data. In administrative data, you observe it if you are at the Fed or something like that. So that leads to, because we are in a vacuum of uncertainty about this asset class, it leads to a lot of different hypotheses. One, that liquidity risk hasn't played out, and liquidity risk won't play out, okay? So let me go through this in 3 steps. So one contention is that private equity and private credit in particular, might be a better way of intermediation than doing things on banking system with runnable liabilities. So it could be that originally these things grew out of Reg Arb around some leverage lending guidelines, but maybe they acquired some technology and expertise and built some models to do cash flow-based lending, as Isil was pointing out, and that they are really managing things better. And to their credit, private credit does have a huge equity buffer. It has what is called as a solvency piece, which is just in the form of equity of its own, equity of the private credit sponsor fund, or the parent, as they are called. They do have some debt, and I'll come back to that later, which is they do raise funds from insurance companies in the form of BBB-rated bonds, etc. And then there is some piece which is held by banks. The bank piece tends to be the senior loans, or they are subscription loans, or subscription finance loans, as they are called. And I think to me, the biggest point of support for private credit, as is made, seems to be that it's a portfolio of services, that the private credit sponsor will do credit in normal times for these middle market borrowers. And then when it comes to them having a hard time, they will switch over to private equity, okay? Which is that there is a debt to equity conversion of sorts that will take place when needed, and we don't have to go through a complex bankruptcy process. We don't need to sell and liquidate assets in a fire sale market. There is a captive equity acquirer of this private equity borrower. When you think about it, that looks very attractive because banks cannot do this. Banks cannot own equity of the firms they lend to. And it could be that bankruptcy is costly, and you avoid some costs in doing this. So so these are just some research questions. We need to know more about these practices. It is clearly the case that bankruptcies have come down in the economy over the last 15 years. Maybe we've not had significant recessions, but that could be one reason why we've not had significant recessions, because there have not been bankruptcies. And maybe this is a better way of organizing the world than putting it all into the banking system. What gives me a pause, I'm not necessarily saying this is right or wrong, is the fact that this government backstop that I was talking about, the central bank liquidity backstop, now seems to have expanded beyond the banking system. We seem to be running very large balance sheets, almost on a structural basis, not just as a backstop for a financial crisis or a COVID-style shock. We seem to be at $3-4 trillion of Fed balance sheet pretty much on an ongoing basis. And this has led some market participants, including my former students who are now hedge fund managers, et cetera, saying there is no pricing of liquidity risk anywhere in the financial system. That there is no one who's worried about liquidity risk at all. They just think there is abundant liquidity, and it will come to their rescue either from this $3-4 trillion that are out there somewhere, or Fed will open new lines of credit, so to speak. There are ways in which this could play out on private credit, which is of the style of COVID, which is there is some view that all these lines of credit from banks to private credit are for balance sheet purposes only. There's some institutional restrictions that lead them to not issue finance outright, but issue subscription loans. But I think that's every time I've seen a financial crisis, someone or the other who's relying on lines of credit a lot from banks and who has just drawn down these lines of credit then gets stuck. And they can't raise market finance for it. So in 2007 summer, this was the large private equity deals that were taking place. I was in London, so there was Alliance Boots deal, and then banks were on the hook for that securitization for which they had given credit. So that's one way this could go out, that what looks like a financing against your subscriptions of investors ends up being actually a bank risk because you can't roll over the subscriptions when they are required, or you don't have incentives to roll them over because their costs of capital have gone up. The other way this could blow out is that there could be, these things are typically rated triple Bs, and so even though you have a huge equity buffer to generate the triple B credit rating on these private credit funds, it could be that just their downgrade to junk is a source of liquidity risk problem for them. So solvency may be a bit later, but what will hit them first and foremost is a liquidity risk, because they will not want to issue speculative grade bonds that throws their cost of capital out of whack, and now they'll become dependent on the banking system at that point. So I think my sense is we need to do a lot more in terms of stress tests as to what are the key breaking points for this model. Maybe we are convinced that there are no breaking points, in which case, well and good. But from a prudential standpoint, it would be better to have done that rather than just believe that this model is the right way of intermediation. So one question that we ought to ask is why now? And we think it requires connecting the dots more than what is being done. I think it must ultimately connect to how we are supporting the financial system in terms of government backstops. It must connect to what the capital structure of these entities is, what is their reliance on the banking system, when will that become a point of concern. And one last point is that as they work out these deals by making them not go bankrupt and taking over their private equity, what is a source of concern is that they do something that looks like equivalent of zombifying these firms. These firms have very low credit profiles, almost no profitability, no cash flows to talk of, and yet they remain on private equity balance sheets for the longest time because they have long-term capital locked in. So it could be that this lack of bankruptcies is actually a source of credit misallocation in the economy. You need a financier that is a creditor in order to force this bankruptcy that will lead to more efficient allocation of capital. So what looks like efficient from private credit or private sponsor in partial equilibrium might be inefficient from a general equilibrium capital allocation standpoint. So more research is needed, but that's it for now.
Thank you, Viral. We will certainly come back and talk about these systemic risk concerns later. Victoria, over to you now.
All right. Well, first of all, thank you for organizing this fantastic panel on a very important topic. So I want to cover a couple of things, but I will speak more directly to private equity, but of course, private debt and private equity are interlinked. And given the ideas that already were highlighted, I wanted to add something else and to be a little bit more provocative here. So the traditional view is that private debt, timeline aligns that it kind of shoots after the financial crisis, and what else happened after financial crisis? Well, it's of course the fact that banks became more regulated and came under higher supervisory scrutiny. And so it is definitely the case that this was one of the factors that helped create the momentum for private debt. But actually, something I've written about recently, I think that the first order cause for development of private debt market, it's actually on the demand side. And there is a fact that there was a rise for the demand for high yield debt financing in the middle market. Why? Because the private equity went that way. Private equity in an environment of low interest rates has received tremendous amount of capital after the financial crisis. That money has to be levered because that's the model. We can talk about it more. But, and that kind of, as private equity pushed into the middle market, it wasn't a financially constrained industry, so it had to push into new territory. That kind of layered with a huge demand for high-yield debt in that market. Private debt existed before 2008, but it was kind of a small, mainly affiliated with private equity fund industry, but that was kind of the scale of the demand allowed for emergence of arm-length private debt providers. And in general, I think that for following the private debt development to date after the even before the financial crisis, it's important first and foremost to follow what is private equity doing, because much of what that industry is catering it is private equity. And touching on regulation, since this isn't the title of the panel, one important regulatory development to think about is the deregulation of banks, the dialing up of the supervisory scrutiny, potentially the dialing up of some capital requirements, dialing down, I'm sorry. And in the view of the world where private debt is just kind of filling the gaps that are freed by the banks, well, that kind of development will squeeze the private debt. I think in the view of the world where private debt is catering to high-yield debt, which banks never did on their balance sheet. Leveraged loan market is, of course, bank-originated, but not primarily non-bank funded market, right? So in that view of the world, that market is here to stay. And I think the right way to think about this is there is a high-yield debt market, that's one technology. So the bond market, then there is a leveraged loan market, which is another technology. And now we have private debt, which is yet third technology to cater to the middle market for much smaller deals which are not suitable for syndication. But of course, all these concerns that were raised are absolutely standing. I just kind of wanted to broaden it, how to think about it, and how it interacts with regulation. Now let me move to another topic, which is, I think that Isil already raised this. I think one of the core developments in private assets more broadly is the so-called democratization. A terrible term that will phase out in the near future, but the idea is basically for the history of the private equity and much shorter history of private debt, the capital was primarily raised from institutional investors, number one group being pension funds. And democratization is about the idea, well, we'll raise money from affluent people in checks that up until recently were in a size of 50K, and most recently, this is one of the regulatory development, went down, so it could be as small as 10K. Of course, it's multiples of 10Ks, but it could be as small as 10K. So this is an idea which is completely different from raising in one shot millions of dollars from one institutional investor. Now, the catalyst for that is the fact that relates to the fact that private equity received a lot of money from institutional investors after 2008. So on the background, there was this dialing up of allocation to alternatives and private equity in particular by institutional investors. Well, by now, they're kind of sitting in 15-ish% in their of their asset allocation to alternatives, and it's not at all obvious that this should go any higher. And so that kind of shifts the dynamic, the growth dynamic for the industry, because at this point they should be growing at the same rate that the assets of pension funds are growing. Nobody is dialing higher than the allocations that they're sitting on. And so that created a lot of pressure from the industry, which is under a lot of pressure to show growth, because many of the largest asset managers are actually publicly traded, and there are a few other reasons for that. So this created a lot of pressure of figuring out how to raise money in 10Ks or 50K or whatever it is. So this democratization phenomenon now is advancing quite a bit. There are a lot of funds, vehicles that are being continuously registered, if you go and look at the SIC filings, by many, many different managers. And of course, there is also another development that is very important, and that is broader 401k engagement with alternatives, where you would be able to invest through your 401k. We are not there yet, but that once that's dialed up, that will also amplify. But even in absence of that, the phenomenon of raising money from individuals is already advancing quite a bit. Now, what to think about as we look at this? First of all, I mean, valuations are different. You have to think about how valuations work. Liquidity management, when you're interfacing with people versus pension funds, is completely different. And I'm sure there will be interesting, I imagine as this phenomena kind of develops and stabilizes, we will be thinking about these issues. Now, the one point that I want to raise today, however, is the following. When you raise money from people, you do not take on counterparty risk. So if you raise money from a pension fund, you, as a private equity firm, you actually don't touch that money. That money sits with a pension fund. You only call it when you have an investment, which is how the private equity works. Now, if I raise my money from individuals at the fund, well, I'm drawing that money today. That's how the entire democratization works. And so that creates a tremendous pressure of deploying the capital, because you instantly take that money. Well, yes, you can sit it in cash, but that will drag your returns down. And so you promise this return, expected return for alternatives, and you want to put it to work to alternatives. So that is one thing that is kind of interesting, and there is no way to kind of figure out what else to do it. You have to take, the dynamic is such that you take the money up front. How do we see it manifested today? Well, the other important development in alternative space is the secondary market, and more specifically continuation vehicles, which is also known as GP-led secondary. What this is that previously private equity would have an investment in a fund and it would be under pressure to exit it. This was a model, the government's model of private equity. Now they can take a subset of assets or one asset, and they can move it into a special purpose vehicle, into a new fund, and that fund will be extended in its life from the original fund. So there is this continuation vehicles. And so the phenomenon that we see of big growth of the secondaries and continuations in particularly is directly tied to the fact that the democratization is advancing and there is a big pressure to deploy the capital instantly. So prediction, secondaries, and you can see them in private debt, in private equity. So secondaries and continuation vehicles will be advancing. They are very complex transactions. There are a few lawsuits already. I think that the market has a huge incentive for figuring out how to iron out those conflicts of interest, but nevertheless, there are some conflicts of interest to think through. I mean, the SEC has already made some steps that will come into effect shortly about how to think about the secondary transactions. I have written with Simon Meyer and Ludo Filippo, and a few others have written about this, thinking about issues and potential issues in the structures of the secondary. I'm going to finish on the silver lining. I'm actually also partly excited about continuation vehicles, because private equity, so it's multi-trillion-dollar industry. Okay, well, 10-year fund translates on the ground that any individual investment is held for 5 years. The last year of the 5 is spent selling the company, so 4 effectively. Now, if you're doing operational improvement, it's better to be something that kind of you have a couple of years of track record, that what you change is actually is there to stay, right? So effectively, private equity is historically has been running after companies and after operational changes that show result in a span of 2 years, because then they have a track record of this is holding. And that is a very small universe. So to the degree that secondary becomes larger and it becomes something that is part of affects how the primary deals are done, it is effectively a mechanism for stretching the horizon, the hold horizon and the investment horizon and the operational improvement horizon that kind of goes beyond some arbitrary numbers that the industry has converged on. So I think that that's potentially positive development, this change in the investable pool.
Thank you, Victoria. I'll come back and ask you more about democratization and also about dry powder and the retail investors. So, Tomek,
First, thank you for setting up this panel. It's great to be here, and thanks to all of you in the audience for attending. I want to start by putting these developments around growth of private credit into the broader perspective of the entire credit market, including other market segments. The first observation I have is that the growth of private credit, I view it as a part of a broader trend of the decline of traditional banking model of intermediation that has been going on over several decades, at least in the US. Just to remind ourselves what a traditional banking model of intermediation is. In this model, deposits are an important saving vehicle. So the savers give banks deposits. What the banks do with deposits, they make loans to households and firms. Effectively, they finance real economy. They keep these loans on balance sheet. And at the same time, they also provide liquidity services to depositors and payment services. As I argue with my co-authors, Greg Buchak, Gregor Matfos, and Amidst, this model of financial intermediation by banks has been in secular decline over the last 50 years. And we also study implications of that decline for regulatory and monetary policy pass-through. There are three kind of main trends that underscore this decline. First, if you look in the 1970s, and the percentage of loans in economy, in the entire credit market, including loans to firms, to households, about close to 60% of lending was financed on bank balance sheet. So in 1970s, we were very much in the bank-centric world of financial intermediation, and it's important to keep in mind that this bank-centric view underlines the current regulatory framework. However, by mid-2020, only about a third of the credit to the real economy sits on a bank balance sheet. Majority is financed outside of the bank balance sheet, a broadly defined non-bank financial intermediation sector. The second fact is relative declines in importance of deposits. In 1970s, deposits accounted for about 20%, for more than 20% of financial wealth. Now they only account for about 10%. And the third force is the transformation of the bank business model itself. In 1970s, the majority of bank assets were loans made to households and firms, about 70%. Now it's about 55%. And part of the transformation is a relative decline in bank holdings of loans they make, and substitution of them by securities, in particular debt securities. You could argue that because the banks are buying debt securities and also they provide credit to non-bank financial intermediaries, our calculations suggest for about $1 of non-bank credit, this $1 is supported by about 8 cents of bank credit to non-bank financial intermediaries. Even if you include all of these things, the traditional bank balance sheet model of financial intermediation is still in a very significant decline and accounts for a minority of funding in the economy. So the natural question to ask is why it has occurred. So with our co-authors using sort of aggregate trends, micro-level data, various empirical strategies, and a structural model of financial intermediation, try to shed light on what was driving this decline of traditional banking, because it is also potentially informative what can be coming next. So kind of in a broad scheme of things, there's sort of several major developments. On a borrower lending side, this is mainly developments of the modern debt securities market. Think about in particular securitization, development of residential mortgage-backed security markets, CMBS, CLOs, asset-backed securities, also further developments of corporate bond market. These developments were further facilitated by information technology, ability to process data, credit scoring, like development of FICO credit score, but also supported by regulation, like creation of government-sponsored enterprises that created a liquid market for mortgage debt securities with some government and backstop. On the saver side, there was also developments of saving technologies, things like money market funds, debt funds, ETFs, and importantly, modern pension funds. So unlike in the past, instead of, depositing money in the bank and bank making loans, you can give money to money market fund or pension fund, and that these entities can invest in debt securities, with some of these debt securities being originated or issued by non-bank intermediaries. Now, if you think about bank regulation and unconventional monetary policies that came after global financial crisis, what's interesting, bulk of this secular decline of traditional banking happened by early 2000. So that's not really a Great Recession story. What happened afterwards, the bank regulation and unconventional monetary policy tend to help shift the bank balance sheet away from loans towards securities. And importantly, we also see another trend. In addition to banks losing their market share in funding loans, they also now lose market share in originating loans. And this first happened in the mortgage market, and now we see this in private credit. In mortgage market, by just at the beginning of, by just before Great Recession, majority of loans, about 70%, were made by banks. Nowadays, non-bank intermediaries, non-bank lenders account for about 60 to 70% of lending in this market. Why is it the case? Part of that is regulatory burden imposed on banks following Great Recession, but another is technology again. Adoption of fintech technology by non-bank lenders like Rocket Mortgage, that become the largest loan originator in mortgage market in US. And what this fintech technology does, this quick online origination platforms, it doesn't really provide so much cheaper cost of credit. In fact, the major expansion of non-bank lending in mortgage market happens when these intermediaries were charging somewhat higher interest rates. They provide customers convenience and speed of a quick origination. An interesting other point, that this is based on my work with Erika Jank and Matfas and Seru, these non-bank lenders operate with way much higher capitalization levels than traditional banks, and the same, by the way, applies also to private credit. These private credit instruments that were mentioned before also operate with very significant equity buffers. So in a nutshell, where we are right now, banks account for fund minority of lending in the economy. Deposits become a relatively less important saving vehicle, and banks are also losing ground not only in funding loans, but also in originating loans. Where I think it's likely to go forward, the private credit is the new innovation that can push further traditional bank lending down, because this is an alternative to more informational, sensitive, balance sheet-based credit, but also developments on the funding side. Think about alternatives to money, like stable coins. Alternative to bank payment systems can further erode advantages on the deposit funding side of banks, which are quite important for their functioning. So to kind of sum up, where does it leave us going forward? So with my co-authors, we've argued that we need first a new model of financial intermediation to capture the reality, but we're in a very different model right now. With my co-authors, we're in a series of papers. We're working towards developing such model, and the model really accounts for importance of debt securities market in financing lending, the competition of banks and non-banks in lending, and the fact that there are important interlinkages between these two sectors. First, banks buy debt securities, including debt securities originated by the non-bank sector, and also banks provide lending and credit support to non-bank intermediaries. And our analysis shows that the modern financial intermediation framework responds very differently to regulatory and economic shocks compared to traditional framework. Just to give you a very simple example, imagine you would raise capital requirements on banks. In a traditional model, given that banks may face some external financing constraints, such increase in bank capital requirements could substantially reduce credit to households and firms. In other words, the banks would make less loans. By the modern financial intermediation framework, this decline will be much more modest, and instead you would see more of a reallocation of credit away from bank balance sheets towards debt securities market and non-bank intermediaries. And just to finish with some thoughts for the panel and for you two, a lot of our regulation are based on the legal entity. So we regulate banks because you're registered as banks. My co-authors, we kind of live in, we call the current framework distributed financial intermediation, when many similar functions are distributed across various intermediaries. So one sort of idea is to think more about how to regulate specific functions the intermediaries are doing as opposed to based on the legal entity. So for example, when you make a risky loans, whether you're bank and non-bank, maybe you should have a somewhat similar regulatory view on this activity. And then obviously, this was mentioned before, a big issue is what is the regulatory perimeter of interventions? For example, when we have a crisis, should we extend these guarantees to non-banks, at what cost, and how to sort of reorganize all of this?
Thank you, Tomek, so much. So now moving on to individuals and their savings and investments and advisory firms. Alberto.
Thank you so much, Isil. First of all, it's a great pleasure to be here. And yeah, I really want to flip the lens here. So a lot of the comments so far have been on PE structures, non-bank regulation. But I work on household finance. I really want to take the lens of how individuals and households are changing the way they save and they invest. And over the last decade, we've seen major changes, in particular with the introduction of technology. So households are now interacting and saving and investing through fintech platforms, through technological platforms, and through disintermediated advisory services. And at the same time, we also have seen a big growth in private assets. And so what I think is very important is to try to understand what is going to be, or how important is going to be, the way individuals access these new private assets through the lens of technology. And so I want to highlight a couple of points related to my research related to individual investors. So one of the things that comes out very, very strikingly is that we know that individual investors, as opposed to institutional investors, are very attention constrained, right? So you have that attention to their portfolios or to financial markets is very heterogeneous. It will change over time, and it will really be dependent on the market volatility. So you really have that, you have the individuals are very different, so they will pay attention to their portfolio and to the stock market or to private assets at very distinct intervals of time. And so this means that the way information is displayed to individual investors is going to make a very, very big difference. Like just at a very in simple terms, I think that one way the regulatory setup is today is that disclosure is the most important way through which we communicate to the individual investors. But in a world of fintech platforms, what becomes fundamentally important is the design. Now, the way information is displayed is crucial. Just as a very simple terms, think about how private credit ETFs are currently, the performance is displayed. If you go on Yahoo Finance, a lot of them you will see is the price changes, but these instruments have a lot of income distribution, so you will not even be able to understand what exactly have been the performance or the total return of these assets. And this becomes important because individuals will not have the time and the ability to understand the intricacy of the infrequent pricing, of the complex cash flows that underlie some of these instruments. So all this to say is that I think it's important to think about fintech not as neutral plumbing. The way information is displayed, the same way it's easy to stimulate attention and potentially overtrading in public market by using reminders and notifications and so on and so forth. It's also relatively possible or easy to have that illiquidity in some of these private credit or private assets instrument will be perceived by individual investors as safety. Now, the second point that I want to make is that when I think about individual investors, you think about two issues. One is the saving aspect, and one is the investment aspect. So in terms of saving, I think that the saving part is actually the crucial part, where you have that, I think having individuals committing to saving is the most important thing for them to secure a safe retirement. And we know that the best way to do it is through using recurring saving plans. We know this from the 401k literature. We also know from this fintech literature, having goal settings and having recurring saving plans are the most important things. I don't feel that the optimization of the portfolio is necessarily crucial in terms of having the extra 1 or 2% in the annual returns. But one aspect that may be potentially interesting on the private asset side is the fact that there is this embedded idea of having this longer horizon plan. So this could be potentially an interesting aspect about the private assets for individual investors. At the same time, individuals we know would need to build up emergency savings plans or emergency savings accounts so that they can withstand potentially negative shocks that they may be affected by. The third point I want to raise is related a little bit on the role of human advisors and robo-advisors. Now, in many cases, people think about the dichotomy of having individuals access financial markets either using a human advisors or having a robo-advisors. So think about fintech platforms like Wealthfront, Betterment, and so on and so forth. But the truth is that we are landing on most of the asset managers now have a hybrid structure. You have that, you have a human in the loop, and you have that a lot of the tasks of the human are now delegated to automation or to algorithms, so that what is happening is that humans can now serve more individuals at lower cost, and so we can actually have democratization of financial advice. So I'm saying this because in a world of public equities, most of the portfolio allocation was delegated to the algorithms. It was very difficult, or it is very difficult for humans to outperform standard model portfolios. And so the way the industry is evolving is to having individual advisors that are becoming more and more psychologists that are more and more there to explain what the algorithms do, and that's the way they operate and interact with the client. Now, in a world of private equity, we don't have a huge kind of evidence showing the performance of individual investors in a private equity, but we have a paper by Petra Avocate, Ohio State, and the co-authors, and what they do show is that it seems to be that the individual advisors actually plays a big role in explaining the performance of individual investors in private equity. So as this to say that in a world where private assets enter the space and individuals can start thinking about investing there, you have that potentially some of the role of the advisors may change and may also become part of being a portfolio where they help individuals choose their private equity options. Now, the last point, and this is something that I'm not super familiar with, but I think is fundamentally important, is trying to, and I think Viral was mentioning this, is trying to understand the liquidity risks. That we know that liquidity risks tend to be ignored or misunderstood in good times, and they tend to bite in hard times and potentially even socialize through ex post regulation. We know that individuals have access to, nowadays, to interval funds without fully understanding, I think, what are the redemption windows, what is the capping of the redemptions as a percentage of NAV. We know that if you look at some of this corporate bond ETFs, senior loan ETFs, we have not seen a lot of disruption, so we have not seen the daily prices deviating too much from net asset values, but this, we also have not seen big crises, so this is something that we need to monitor going forward. And partially, I'm worried about this because illiquidity may amplify a lot of the behavioral biases that individuals may have, and so we may have them exit the market right at the worst possible time and lose a lot of their nest egg for retirement. But thank you so much. I'm looking forward to the conversation.
Thank you, Alberto. We will come back to the liquidity risk, but I would like to start our discussion focusing on the democratization of investment in these private assets. You know, any question that I pose, feel
free to skip or answer, and soon we will open for questions from the audience as well. So we all mentioned that in some way. It's a big topic now, like this opening up investment in private assets to individual investors. And Alberto, you talked about the role of advisory firms. And I also want to emphasize that some of these advisors are being acquired by private equity firms now as well. So given all this, how do you think about this democratization?
Yeah, so I think this is a very important question for a number of reasons. So number one, I think that many advisory firms, there is a philosophical stand that many advisory firms and asset managers need to make. In some cases, you have that they will choose to cater to investor preferences, and in some cases they will, or biases, and in some cases they will try to correct them. And you have that some financial advisory firms will not have their investors be investing in the cryptocurrencies, for example, or in private equity. And the idea is that they do not think that these instruments are the right fit for their investors base, maybe because they are not affluent enough and so on and so forth. I think that there is a number of issues with these decisions, of course, and I think it's twofold. First of all, you have that if individual investors have a desire to purchase some of these assets, they will do it on one platform or the other. So you have this fundamental, complicated aspect that even if you do not offer these products, some of the others firms may be allowing some of these investments, and so you may lose clients on that side. But one less understood issue is that you also have that in many cases, advisors also think about their own careers. So they will choose to work for firms that will allow them to have more clients and accumulate more assets. And so you have that, you may also lose a lot of the advisors and the talented advisors for companies that will allow this type of investments. Now, on the second point you touched upon, which I think is very interesting, is yes, we've seen that a lot of the asset growth in advisors in the financial advisory space has been into firms that have been acquired by private equity firms. So you have that the biggest growth is in there. And I think that one reason why this has happened is that financial advice has been one of the spaces where the fees have been relatively large. So you have that historically a financial advisor would have charged maybe 1 or 1.1% a year of assets under management to their clients. You have that robo-advisors are instead on 20 basis points, 25 basis points, but now you have that a lot of private equity firms are coming in there doing exactly what I was saying before. They are trying to introduce technology to increase the profitability of each advisor, and they're going to squeeze down and they're going to reduce the fees and then they're going to make this market more and more competitive.
Thank you. Any other comments on democratization?
Yeah. Of all the trends, at least from a financial stability standpoint, I worry about democratization the most. I think the whole selling point of PE had been that, we have long-term investors, we have the subscriptions which are locked in for 10 years, etc. I don't see how going down to levels of 10K, etc. for funding will be disassociated with not selling some redemption rights. And then PE or private credit model looks more like a runnable model, like demands for redemptions will come in at some point. They could become easily more systemically important, or at least politically systemically more important, because it's mom and pop savers. Okay, 10K, fine, it's maybe high net worth, but you'll still get calls to senators from every other person in the street. So I think what PE is trying to do, what private credit and equity sponsors are trying to do, is to get at the real savings. They want the savings that are going to banks, they're just calling it kind of like a 10K subscription. It is a deposit, and ultimately we'll have to treat it like a deposit, which is to the extent the government puts to it.
I can add, just to be clear, that even though as you said, there's a lot of experimentation with different vehicles through which democratization, access to private equity or private debt is available to individuals, but a consistent kind of element is, yes, they have more liquidity than traditional private equity model, where there is zero liquidity, but it is very, very limited, right? So there are, it's the usual kind of structures that you would expect. First, I mean, there is penalties if you withdraw within the first X years or months. Second, there is a cap on how much redemption on aggregate there could happen. There are windows for redemptions that are not, redemption is not instant. If there is no easy way for you to react to market, which is one of the elements that typically feeds into fragility, because something happens in the market, you immediately want to do that. Well, the majority of the vehicles, the bulk of the vehicles that are created are not synchronized in any way. One interesting thing to watch also is what you can see on the private debt side, which was ahead of private equity on democratization, is that it's migrating from public kind of lack of being, some of these vehicles were raising public equity, migrating into the structures that are, offer very limited liquidity and very slow liquidity.
Sure.
So that's something to consider as you think about fragility of the structures.
Sure.
Just to add, I'm also worried a bit about governance and monitoring mechanism. You know, if you have a private credit and the providers of equity are, you know, limited partners with just institutions, wealthy individuals that have more experience in financial markets, I worry that, you know, if we go to the retail side, you're going to have adverse selection. You're going to have lack of governance and monitoring unless we put that regulatory framework in place. I'm actually familiar with quite a few crowdfunding platforms in the real estate space, and there's some good ones that have good sponsors, reputable sponsors that care about reputation, but there are also instances and signs of very serious governance issues, if not an outright fraud in these instruments. You know, if you raise money promising investments in assets, but there's really no monitoring governance mechanism. That's why we have Security Exchange Commission, liquid capital markets. There's a cost, regulatory cost to pay to be there, but there are some mechanisms to safeguard the little person investment rights. So that's what I'm worried a little bit of, moving there without having a proper regulatory infrastructure to support sort of monitoring of these investments and reporting on the quality and so on.
Yes, yeah. I'm personally very worried about the perception of risk. So when people ask about, you know, democratization and private debt, to me, they always also give the example of cryptos, right? Like, you know, they say, oh, we let individuals invest in crypto. Why not private debt, which is much less risky? But I think the problem is the perception of risk, as I said, you know, because very often it's pictured as very high return with very low risk. But as I just said in my opening remarks, you know, that's not necessarily true. And, you know, all these large institutional investors spend all this money and effort in doing research to understand these risks, and, you know, and pick these investments for various reasons. But how we educate, you know, individuals will be the key, and the role of the advisors, I think, will be extremely important. You know, and I think it will be very hard to educate them, right? You know, on the risks, you know, fully. Okay, also talking with the practitioners, I think they have mixed views about this as well. So some of them are very eager to get into this democratization world, but some of them are very cautious, and that speaks to the regulation, I think. You know, we also talked about this, right? So how do you think about regulating, you know, this market? So do you think
they will stay if we end up kind of putting more regulation? You talked about regulation, Viral, stress tests, for example.
Yeah, means I'm of the view that to start with, we should just understand the asset class a little bit more. I think private credit is still small right now, even though it's been fastest growing, like it's not as large as the bond market or something like that.
It surpassed the high yield bond market.
Yeah. No. In grand scheme of things, we are talking about
Yes.
10 trillion versus 2 or 3 trillion, you know. So, means I'm happy with some experimentation happening along the way. One, I would like to see more data in the public space beyond just administrative data with the Fed, because, you know, if the data are with the Fed, then there's a limited amount of stress test disclosure that they will provide, etc. So why not make more clear what the bank linkages are if ultimately we think bank and the deposit runs are the big source of systemic risk?
Opaqueness is the main issue, right?
Opacity could be another big issue. Like, one question I have is, okay, everyone says they have big equity buffers, but is it big relative to the opacity or the illiquidity of the assets that they have? Like, we know small businesses are not very levered in the sense that they have a lot of internal equity risk of their own, and they are really putting up a lot of their personal assets at risk. But, you know, we don't ask that question of private credit fund. Like, we just say, okay, we observe 50% assets are in equity, and we think that's good enough. So I don't know what's the right question. I would like to know what the true underlying opacity and illiquidity of the assets is. But one thing I want to stress on regulation is, I'm of the view that I think the Fed has been, and the central banks in general have been too agreeable to opening up the liquidity taps for non-banks. I think any case for non-banks that I have seen must reside on the fact that this is a better form of intermediation, because ultimately we don't have to bail them out and give them the large government guarantees, etc. But if we are just going to bail them out at the time of quick bout of volatility every single time, if that compromises the balance sheet size of the Fed every now and then I think we are just re-engineering the government puts by allowing the risks to migrate and then guaranteeing those risks. So a limited form of regulation that I would like to see, I don't think it's going to fly as of now, is that any entity that is deemed as systemically important and because of which liquidity taps are opened up by the Fed, ultimately Fed should have the control rights to supervise them. You know, we routinely say we should intervene in government bond markets because hedge funds are going to destabilize them. But then get a handle on hedge funds, you know, like why do you want them to destabilize the bond markets? So I'm saying one futuristic principle that would work well in case private credit becomes too large, it becomes too much of a source of systemic risk, is that if at all it is found to be a problem, we'll open the taps, but then we have to get more disclosures out of them or get even supervisory and regulatory powers over there.
Victoria, what do you think?
All right, so most of the structures that are used for democratization are registered investment companies, RICs. BDC is a form of RIC. There is slightly different regulation, but it's basically spin on a RIC. So one way to say what is it, so whatever we see for BDCs, and we see a lot, right? We see quarterly allocation by BDCs. They are required to have 3 independent directors by SEC. So between the governance structure and the closure, there is already a lot happening. Let's acknowledge that. So we have to be clear about what is it that I think that one way you can phrase this question, and we just kind of, let's focus on BDCs because we already have done a lot of research on BDCs, and so it's more relatable to many people here. What is it that we would like to know about BDCs? What else would we like, or in which way would we like to regulate BDCs, right? And yes, there are maybe some questions, for example, like what is the contingent connection to the banks. Like for example, we don't know the covenant structure on the bank credit provisions to the BDCs. And it could be that actually that senior secured position and undrawn revolving line, well, it actually shuts down pretty quickly if there is a performance in assets. So no big deal. Actually, bank is not on the hook for any liquidity. Or it could be that there is no stop, and the second BDC will run into problems. They'll just draw the entire thing on the revolving line. Well, that would be nice to know. And actually, that's not a stress testing. They see the line, but they don't actually know where it stops. So that kind of would be useful to know, but does it mean this requires more regulation? No, it sounds like the Fed needs to understand a little bit more better the contract that they're looking at in stress testing.
I think when we talk about opaqueness, we talk about the opaqueness of their portfolio of investments, and they always claim that they have a lot of data, but I think sharing this data, perhaps with academics, would be the
BDC.
best.
So,
Yes,
so we already have information on BDC. Everything that is a register, everything that is a RIC has quarterly disclosures. You're interested in private equity vehicles, we'll go to SEC website and download them. So what is it that we would like to know? Would higher frequency? Well, it doesn't exist at higher frequency. It's a quarterly frequency.
But BDC is only 40% of this private debt market, for example. Like, there is more.
Fair.
Like,
So if we're going to talk about private debt, then that's an important point, because this is a shifting target of how much of it is BDC, because BDC caters to retail, to institutional, to individual investors, whereas credit funds cater to institutional investors. As democratization advances, this kind of will continue shifting, but the bulk is still sitting on the credit fund. And good point, credit funds, totally obscure universe. But if we're going to talk about private equity democratization, well, that's an equivalent to BDC. That is sitting on SEC filings mostly.
Great. Any more comments?
I just have a slightly different comment. I think one complication that is emerging is a little bit of this regulatory uncertainty. So what we've seen is, for example, at some point we had the private fund advisor rule from the SEC that then was struck down. There was was requiring advisors to distribute quarterly information regarding the fees, the performance of the funds, and so on and so forth. And I think that what has happened also in the last couple of years, we had, even in the context of technology, at some point there was a predictive analytics rules that was supposed to control the conflict of interest related to the deployment of technology in the context of financial advisory or automated advisory services. And that was also something that a lot of firms were gearing up to and preparing for, and then it was once again withdrawn. So I think that there has been a little bit of regulatory uncertainty in terms of how to operate and what is the field in which these asset managers have to operate when they cater to retail investors. So, but in terms of the main issues that I see is that I think that once again, I think equating disclosure with comprehension is a big complicating factors. I think that once again, it's going to be very important to try to figure out what is the design of the platforms and the information displaying. And I think as once again, one complicating factor is as soon as some of this private asset enter into 401k plans, then it's going to become it's probably going to skyrocket also on the retail side, because implicitly they will be certified as assets that are suitable for individual investors.
So, Tomek, perhaps I should ask you my next question, and then I will open it up for questions from the audience. I think this is just related to what we have been discussing about risks and regulation. So, in case of a likely recession, how do you envision private assets or debt to help or hurt in this situation? You know, you mentioned equity buffers. I am personally less concerned about, linkages to the banks, but more concerned about linkages to other institutions. You mentioned, pension funds or insurance companies where you're linked to them, or any other concerns or benefits you have in mind.
the private credit and more broadly non-bank financial intermediation sector can actually be stabilizing in recessions too. In fact, in our counterfactuals, in our new modern model of financial intermediation, you can show that when banks face, for example, capital shocks during recession, the non-bank sector can to some extent replace them. You know, the banks, instead of originating loans, they can sell them. I'm less concerned about solvency part of the private equity funds and private credit in general, because they're pretty well capitalized. The mortgage lenders have at least 20-25% capital buffers, private credit funds 50%. There is an issue of LPs capital,
Yes.
and that's where the losses could be. You know, they might not be systemic in the sense of creating a big financial stability risk, but it could result in losses to pensioners and other folks. In fact, you know, we talk a lot about the non-bank sector, but I'm actually still worrying quite a lot about traditional banking. I think we have not resolved the issues therein. We're worried about risks to non-banks, but those are the banks that operate with 10% equity cushions and 90% debt funding, of which about half is insured and half is uninsured deposits, which means that even a modest 10% decline in asset values of the banks can potentially put them into insolvency. We saw it during the regional banking crisis in 2023. Banks take credit risk, but they also take a lot of duration interest rate risk. And as rates rose, you know, we saw a significant number of banks being subject to runs. Of course, the regulators intervene at a significant cost and short-circuit the run, but these problems have not been addressed at all. You know, if anything, you know, our work suggests that we could substantially raise bank capital requirements without not as much aggregate cost to the overall credit. Instead, you know, this idea of recapitalizing the banking sector has been diluted. The banks continue to operate with very high leverage, and they're very sensitive to interest rates. You know, we just have a paper that came in a Journal of Political Economy Macro last month, when we did the stress test of the banking sector for higher interest rates. And you know, once the 10-year yield reaches 4.5 level or higher, a significant number of banks are at risk of potential runs by insured depositors. And this is a solvency, not a liquidity problem. And we still implicitly provide safety nets to the system. So for me, the one step would be to recapitalize the banking sector and make it more stable. And then we can think about, you know, the non-bank sector, the linkages, and so on.
Yeah, thank you. I will ask Viral about his views, but first, I would like to touch on the demand side and borrowers, Victoria. You mentioned the demand side for this growth. So one thing that we have been observing is the increase in the dry powder. You know, it reached to, in private debt, that I know, like about 40%. Now I think it's around 30%. And should we be concerned about lax lending standards, especially going into a recession? And when something happens to these lenders, what will happen to the borrowers is what I'm a little bit more concerned about. You know, I would like to get your thoughts about this as well.
So on the point of the dry powder. So first, I mean, dry powder for it's a very normal phenomenon in private. We can follow dry powder accumulation and disaccumulation in private equities through many, many decades. If anything, it relates to points that Viral was raising earlier, touching on earlier about the financial stability and liquidity need. Actually, is that dry powder, which kind of often you have immense amounts of dry powder right before some financial shocks, because dry powder is a function of fundraising, and fundraising is typically booming right before we run ourselves into a wall. And so that oftentimes often acts as a liquidity line, because you have access to capital from institutions. Now, on the demand side, that's a point that I want to raise. So accumulation of dry powder per se doesn't concern me. If anything, it's a good thing. It doesn't, I think that there is not it's a function more of fundraising and than a function of, oh my God, what do I do with this money? I don't have anything to do. Let me just start lowering lending standards. I don't think that it not necessarily translates into pressure to deploy.
Okay.
The pressure to deploy that I was raising is a very different point. Now, I think that it's not so much related to dry powder, but I earlier said that to understand private debt, you need to kind of follow private equity until now. But the private debt fundraising machine and the private equity fundraising machine are not perfectly in sync, right? And in fact, the private debt is still going, and private equity is kind of sitting there still. They were not exactly they've been struggling to fundraise. And so that concerns me. And a lot of like this running around and doing mega deals here and there and trying to figure out, do we do asset-based lending? Do we do litigation finance? Do we do the royalties? Which one is next? That is a little bit all over the place. That one I would be watching very carefully. It kind of, if anything, this point about, it's not so much out of the dry powder, but it is an element of like private debt is still fundraising a lot, and private equity is not. That means that they have to go somewhere else.
Yes,
And
that's
this
what
somewhere else running experimentation is something that we have to watch closely.
Thank you. So at this point, I would like to open up for questions. There's a microphone there, if you don't mind walking towards that.
Thanks a lot for a very interesting discussion. I have sort of three quick questions. The first one, to be honest, is a little bit about, is there something wrong with bank regulation in terms of the lending to private debt funds, in the sense that you can circumvent, rather than take it on the balance sheet, it seems to be cheaper to go via the private debt funds? Are we putting too low capital risk weights on lending to these funds? Is that the arbitrage? The second question is a little bit about, normally when we think about financial stability, we think a lot about the liability side, the losses on liability, but the big issue is also the procyclicality in the asset side, in the lending. And if we are tying the private equity and private debt funds to banks, are we then creating procyclicality also in capital markets, so that we will have what you would call credit crunches implicit in the way when things go up and down? And the last question is in relation to the democratization. I can't help think that there's enormous asymmetry in terms of information between those trying to push the financial products and those investing 10K or 50K or whatever there is, and whether we won't down the road have an enormous risk of tons of lawsuits in terms of mis-selling. So those were three questions cutting across. Thank you.
Thank you so much.
Viral, I knew this question was going to come, that's why I did hold on.
Yeah. So I think the question of whether one can use bank regulation to contain the spillovers is I think, a very good one. It's been my view that, like, having worked a little bit with Nicola Cetorelli on the Y14 stress test data, that actually we can get at non-bank regulation even though Fed doesn't have the regulatory powers over them, at least in the limited sense that we can contain the spillovers to the banks just by thinking about stress testing the drawdowns. So let's say there's a macro slowdown, let's say a recession, which right now would mean pretty much all sectors would go down, because all sectors are down other than AI, in my view, in the economy. And so there would be a correlated drawdown on these credit lines. That's a time when banks will be making other provisions for losses because the sectors are down on their own loans as well. And you could decide what's a prudential capital requirement to do this. I don't know to what extent the Fed is doing it because we don't know the stress test toolkit. Last year, I think the 24 onwards, they did a stress test as a part of the solvency stress test, the drawdowns. So I think let me just clarify here what I mean by the stress test on the thing. So the liquidity risk is not being analyzed in the stress test at all. But one thing that happens when you do a drawdown as part of the stress test is that what was an off-balance sheet credit line becomes an on-balance sheet kind of loan. You can call it a term loan because the repayment horizon will be several quarters, at least in a stress test. And so that has an enhanced capital requirement once it becomes an on-balance sheet exposure. So it's like a drawn amount rather than an undrawn amount. So at least that we can capitalize, and that would give us some comfort that banks, if they are being charged more, then they would pass on a higher credit line for a higher credit charge for this facility to the private debt vehicles. But I think the way I would like the stress test to be useful is also like to not just think about banks. Like I'm really worried about, like I'm stunned we have not seen more bankruptcies. So here we are calling for more Fed cuts because of unemployment, etc. And look at the corporate scene. It's remarkable what's the stability in the corporate scene. So either we have manufactured credit in a way that doesn't require people to go bankrupt, or these skeletons are in someone's chest. My sense is that I think I'm quite worried about what was in period of high interest rates, what was amend and extend for private credit has now become extend and pretend. They are housing a lot of firms which I think could be in these rollover vehicles. They might be democratizing precisely because they think they can pass the lemons down someone's throat, etc. So I think we need to get a better handle on this problem because I'm quite stunned that here we are saying economy deserves lower rate cuts, and I see no corporate credit slowdown. No corporate repricing of anything, even in the high yield space. And I agree, the high yield space has been taken over in part by the private credit, but that then is a matter of concern to me because junk bonds were used to be seen as collapsing every time the economy was teetering or thought to be teetering. And now we don't see junk companies in any problem at all. Like where is the credit risk?
Any other comments?
Junk bonds is unsecured debt and private debt is senior secured. But no, you have a good point. Just I don't think that analogy might directly might lead us to
no. That's what I said. But I would like to understand if we have just manufactured credit in a better way. I think you are saying we have.
It's not apples to apples.
Yeah, but what is the collateral? I thought cash flow was the collateral for these loans. So what is the security?
Yeah, I mean, just on the last point on the democratization and the potential losses, I think absolutely, and I think that's why a lot of the companies and asset managers are very cautious about it. You'll see first this type of products being in brokerage account or broker-dealer type of relationship, and not so much in fiduciary type of relationship. But I agree in what will probably happen if you have some significant losses, then you're going to have lawsuits, and then there's going to be in the same way we had resale lawsuits. Now we're starting with sweep account lawsuits. You're going to have even though you're going to have any sort of disclosure terms you may want in prospectuses, you're going to have that this industry is going to have some lawsuits.
I would like to make one point about the collateral, right? Like now that we are
getting into the asset-based lending, I think that will be even more important. And these are random examples, but some of the recent bankruptcies speak to that as well. And with increased corporate leverage now, are these firms more vulnerable to shocks is another problem. You want to?
I want to give one example. So private debt, let's assume that it's basically to date is backing up private equity. And the leverage in private equity transaction is 50-50. So if you believe that, let's put the private debt market or private credit market at 2 trillion. So there is 2 trillion in private debt, 2 trillion private equity, which is subordinated to it. And so if we are concerned about private debt, and look, I mean, there might be a reason why we are concerned, but if we are concerned on the scale, I think we should spend a lot of time talking about those burned 2 trillion of private equity that is sitting throughout pension funds, etc.
Yes, sure. Yes, please.
So one of the challenges is that the banks play both sides. So they're lending to the private debt facilities, and they're lending to the institutional investors to invest in the private investment. So banks don't want to take losses on both sides, so they'll continue to zombification, in your words. And it's really hard to do a stress test because in the Y14, you don't get the granularity of where's the investor and where's the private debt. So you can't do a typical stress test. The models don't really capture it. There's no losses, as you pointed out, because as the private debt need money, the banks are funding it because they don't want to have the investor lose money. So in the end, the banks are going to hold all the cards, but you won't know that until the house falls down. And I know the Fed has been trying to get to this because, at least at my institution, they've been asking a lot of questions, but there's really no way of modeling it without having a theoretical cash flow model on both sides, and you don't have the opacity of the private debt market to really understand what their cash flows are. So in the end, I don't know what we're supposed to be doing until it all falls apart. And I think that's what happened with Silicon Valley. I don't know if you guys have anything to say on that.
Yeah, I think I agree. So there was a nice article in Financial Times which had this schematics of what you're talking about, like, at what layers banks are providing liquidity or term loans or credit lines. I think it would require, because what you're talking about, the cash flow model of private equity, means understanding that business. It means understanding what is the source of stability that private equity is relying on to support its private credit funds, like the sponsor of the private equity, etc. And I think we need a cash flow model of that type, but that means we need a better disclosure at the level of private equity itself, the private equity sponsor itself who are issuing these private credit funds. That would be a way to go, but that is very hard because that requires regulatory powers over the funds. And when we talk about the funds, we only talk about SEC, whereas the prudential regulator is basically the Fed. So I don't know. I think it's, once again, it's going to fall through the cracks. That's my prior. But I'm hoping that something else breaks down before we have a crisis of private credit.
Any other comments? So, I mean, this is a great question. I totally agree that we keep talking about linkages to the banks as lenders, but I keep raising this point that we should think about linkages to other institutions as investors in these funds, pension funds and insurance companies, and their liquidity constraints, especially that could be binding in likely losses or in recessions. But I didn't think about that linkage, linking back to the banks as well. That's a very good point. Thank you. Yes.
Thank you. It's a great topic. I have two questions. One has to do with something you guys discussed, which is monitoring of those systemic risk. And one way we've been doing in the private sector is look at the corporate bonds for those insurance companies, those pension funds. They have to go into the market. I'm really curious in something you mentioned, which is look at those companies that are at the BBB rating, with the risk of going down. So we'll look at things like default probabilities to see the health of those companies that might be on the verge of something going wrong. I guess my question is then, what else can we see right now in terms of monitoring the risk in any of these players right now in the market to know that something might be coming? That's question one. Question two has to do with another aspect, which is the return. And I think how players can participate in these private credit markets. So the returns I'm looking, you mentioned about alpha being zero. So I'm curious of if you break down by either a retail investor or the ones that participate directly into the fund, what kind of returns are we looking for? It's like high yield returns type of, or something different. And then secondly, I know a lot of the money center banks, especially in New York, they participate as issuing other loans to non-NBFIs. So I'm looking at if you see any possibility for regional banks participating in that space, particularly because of lending and other type of loans are drying out, like you mentioned. What other options those banks have to participate in this obviously increasing market? Thank you.
Thank you. I can make a quick comment about the returns. Unfortunately, we don't know the investors, so I cannot really differentiate among investors. But we do differentiate among different types of funds, and the results are not different for distress versus direct versus others. And this is zero net alpha after adjusting for high fees and various risk factors. So about the other question, yes?
Maybe I'll just kind of a follow-up comment on the risk right now in the system. Like, I think there's a lot of concealing the actual vulnerability. Like, we already talked about the duration risk. I think both some private debt funds that have loans that are about to mature, and in particular, the traditional banking sector has a lot of interest rate exposure. The regulators explicitly have not addressed it. I know they're aware of that. Like, look on a stress test of the major banks in US. The best scenario is zero interest rate or very low interest rate. The real risk is high interest rates. We know that that's why there's this tremendous push on lowering rates, because it would help the banking sector. It would also help some private lenders that have a portfolio of loans that are maturing. One area is commercial real estate. We did analysis of combination of interest rate exposure and commercial real estate exposure. Because of higher rates, work from home patterns, hybrid working patterns, about 14% of commercial loans right now are underwater, about 44% of office loans per our loan level analysis. The banks and some private equity funds kind of, on the debt side, they pretend and extend in the sense that, well, in a year and two, when these loans are maturing, hopefully the rates will be lower. But the 10-year yield has not substantially declined, quite the opposite. I was just looking this morning and went up again. And our analysis suggests that at the level of 4.5% or higher, the system must start breaking again. And then again would bring a need of government support to the traditional banking sector and potentially some private intermediaries. So I think this is an important source of risk. The natural way to do would be to recapitalize the banking sector. That will also help address all these issues of linkages and exposure of bank to non-banks, because if they had more capital, then we as a sort of taxpayers will be less worried about supporting them on the deposit side. Because for a moment, we practically extend deposit guarantees to all kinds of deposits without really forcing the banks to seriously address the inherent risk in the system.
And one other, go ahead, please. I have
a very small point. Zooming on the private credit, because specifically you raised this point about for rated companies monitoring downgrades. Well, private debt companies are not rated, but in indicators that seem to have emerged, and there are many sources that are looking at it, is use of pay in kind, right? So companies that, and especially those companies that didn't originally have a pay in kind, but then renegotiated in the pay in kind, which speaks to the point of behind the scene restructurings, that kind of being a potential indicator of restructuring. So a couple of sources have been tracking that, and so this seemed to be an indicator in the private credit market.
One comment you made was about hybrid structures, Viral, like, or convertibles. And I would like to come back to that because I have a paper with Tatiana Daviduk, Tatiana Marchuk, and Wei Zhang, where we look at funds investing in equity and debt of the same firm. And this can be in the same firm, or it could be, as I said, like, equity investment in the fund. And it could be warrants, convertibles, or even common equity. This is very interesting because banks cannot do this, right? Like, they cannot invest in the equity of the firms, but these structures can. So how do you think about, these funds being equity holders and shareholders and creditors in the same firms?
Yeah, no, I think it's a very interesting observation, and I think the jury is still out. Traditionally, we think like what Grossman and Hart would say is that, to solve the hold-up problem, we need to have some states in which you are liquidating the guy. You're liquidating the entrepreneur or liquidating the promoters or owners of the company. So I think on the face of it, it looks kind of attractive that there is this seamless conversion or transfer of debt claim into like an equity claim. But I don't know if that would be efficient from an allocation of credit standpoint. So I think it goes a little bit back always. It's also to this payment in kind thing, which is like kind of creating like an equity claim out of a debt claim. So I'm scarred by zombification of the economies. I think there is something worse than financial fragility, which is that you don't recognize the problems. And that leads to a huge misallocation and lack of productivity in the economy. I don't think we are there yet, but I don't know what's the scale of this problem. So I think what I would like to be the outcome is that the debt claim gets converted into equity, but then it's sold in the market. And then at least if that acquisition is happening from the private equity sponsor at arm's length, rather than as like an internal deal from debt to equity, I think there would be some efficiency of allocation in that market. But I don't know if I should necessarily feel good that firms that are not having any cash flows when the economy is down, that we can make them not go bankrupt because private equity firm has long-term liabilities.
What do you think, Victoria?
A lot of things. So let me, perhaps on the companies that don't cash flows, let's just be clear what this is. And I think by now I'm an official cheerleader on this panel. But companies that don't have cash flows typically are companies to which lending is done on recurrent revenue basis. So what happens is that some service technology companies, or same is true about oil and gas and some industries, other industries, is there are a set of clients that are already acquired which are profitable. And the money is lost, and what drags you into negative cash flow territory is through acquisition of new clients. So just to be clear, you're lending against an acquired client base, and you do a lot of due diligence to make sure that those clients might not switch your software too quickly. So private debt does have a recourse of, they can shut down the acquisition of new clients, and that company going to be cash flow positive for purposes of repayment of debt in all time. So that's to clarify the cash flow negative and how horrible that is. One thing about private debt is that they currently don't have in-house capacity for doing what equity does. And I think that going to Viral's point, there are more layers to it that I don't think they exactly incentivize, might not be incentivized to necessarily jumping to private equity. But one of the reasons is that look, having equity requires you being invested in a company, and that's not what these companies do. It might, to the degree that they do that, there is also some losses are coming from the fact that this might not be the best entity for running equity.
Mm-hmm. There is one question. Yes.
So I have two questions, picking on the themes from the discussion to something a little bit more specific. So I think there is a lot of money flowing into private credit at the moment, and the panel has spoken about the opportunities not being as abundant, particularly on the private equity fundraising side, creating sponsored deal for private credit. Is there a particular metric or a particular set of metrics you would look at to get a measure of slippage of standards, underwriting standards? And could the regulator motivate the private credit funds to disclose it? So that is my first question. My second question goes back to the democratization point. And on that, is there any disclosure or minimum viable standards on liquidity or valuation disclosures or risk disclosures that could help that transition as it happens?
So we have 5 more minutes. Victoria, first, very quickly, I thought this question was to you, and then I have a question to Alberto.
There were 2 questions. So which one do you think was to me?
Go ahead.
All right. Well, on the slippage of standards, I think I have written a lot about slippage of standards in the leveraged loan market. I think it's the same thing here. It's about contracts, underlying contracts, and the covenant structure. I don't think that regulators doing anything about following that contracts in a good way in other markets. I would be surprised that they figure out how to do it in a private debt market. Generally, it's private markets that figure out, and there is agencies like Fitch and Moody's, etc., that kind of start tracking these things as demand appears. On the valuation, I mean, this is a point that, look, there are SEC guidance about how the valuation works and how it ties to the primary valuation, because valuation of more frequent valuation is still tied to the primary valuation. So it's, if anything, we need to go back and think about, well, this primary valuation and the way it's reported, is this proper or not, beyond, like, before we go into democratization. But given that there is an industry that operated for a long time and institutional investors that we believe are sophisticated, are comfortable with this is used by SEC as a reference point. And beyond that, there's quite a bit of disclosure again about how these marks are used for purposes of reflecting it in the quarterly reports of for RIC structures at least.
I just, on the second point on the disclosure, as I mentioned before, there was this private fund advisor rules that was struck down that was supposed to have the advisors having a kind of reporting quarterly the statement, the fees, the performance, but that has been vacated, so you don't have that now. But I think that this space is changing so quickly. I mean, together with the AI space coming into play, really the SEC is playing catching up on all these. The complications are also raised by the fact that now even what is advice is changing. Now you have that with AI coming into play. A lot of new companies are trying to implement some of the strategies that the investor may have and not call it advice. And so this is a very rapidly evolving space that doesn't, but I think, yeah, we definitely need a lot of work in terms of disclosure. And as I mentioned before, the design of the information display to the investors.
Alberto, can I follow up on that? You know, so this huge change perhaps is due to fintech and the changes in AI.
And how do we think about humans versus robots? You know, so in our savings and investments, especially with investment choices getting more complex now, you know, with kind of private assets getting involved, and etc. Do we still need the human involvement, or will the robots do it?
I think that it's funny because this is it's changing more than ever, right? So you have that. I think that one of the aspects that people underestimate in this space is the importance of behavioral coaching and making or having people stay the course. So you have that, of course, in the context of in particular public equities, the portfolio construction is not necessarily that it is not privy to the advisor. Something that is something that can be fully automated, but there is more and more research now showing that the role of the human touch makes a huge difference in terms of retaining investors onto the platforms, staying them invested, maintaining their investments. Because one of the heartbreaking aspects of individual investors is that once they lose faith, they just drop out, and then they lose on the equity premium, and so they lose a ton of potential appreciation for retirement. So I think that's the margin we should really think about going forward.
Thank you. With that, our time is up. I learned a lot today. Hopefully it was interesting for you as well. I'm very thankful for your time and for all you shared with us. Thank you.
Thank you.